Hi, everyone. This is Unicorn VC again with your Ask Your VC podcast series. Today, we're going to be talking about how to value an early stage startup. So, Vispy and I have often come up and spoken to entrepreneurs who have this very common question: how do I value my early stage company? What's a fair valuation? So, that's what we're going to talk about today. Uh, just at the outset, let me just make it very clear. Occasionally, an entrepreneur comes up to me and says, "Look, I ran a discounted cash flow model on my company, just like any other, MBA analysis of a standard company, and therefore my company is worth $15 million or some number, right?" So the first word of warning is, throw that away. DCF or discounted cash flow analysis is not it's not a good way to value startups for various reasons, which I don't want to go into too much detail here. But there are many other much better ways of valuing startups. So, Vispy, why don't you take the first shot at what's a better way to value a startup?
Yeah. Yeah, Murli, I'll agree with you on the financial analytics around discounted cash flow, NPV, or any of that. But the reality is, depending on the venture side at least, depending on stage of company, a few different metrics would come in. So let's take a later stage company, again, a venture round that's occurring, and the next round is most likely going to be a public offering, and that's how they're going to raise capital. Then for that round, for sure, public market comps would come into effect. So any Series B onward company that's raising a large round to go public shortly, the trading comps for their sector in the public markets would be very, very relevant. Comps around revenue, growth, profitability. Those would be broadly the three. But let's take the other extreme, your first round, whether it be a seed round or a Series A round. Public, even though you do belong to a particular sector, public market comps do exist. It really wouldn't be as valid because your company is just starting out and your growth rates and your revenue rates, etc., aren't reflective of what they're going to be when they're at scale. So in that case, it wouldn't come about. I would say much more sort of industry norms would be the case in the early stage. I'll turn it back over to you, Murli, and talk about some of those norms.
Yeah, industry norm actually is the perfect way to characterize it, right? So coming back to, we're not talking obviously about the super late stage, but at the earlier stage startups, typically when you go out and raise money, the most common way to do it is to raise decent sized checks for that particular stage and keep doing that every so often when you need it, so that you build your valuation over time. So you're not raising $20 million in your first round of funding, nor are you raising $2,000. It's somewhere in the middle. So for your first round, if you're going to a bunch of angel investors who might be people that you know personally, uh, very often we'd suggest that the best way to do it is not to use priced round as we call it. Is essentially to take a convertible debt approach. Is fairly common. It's not uncommon to take price round approaches as well, but there are many advantages. The most important of which being speed to taking a convertible debt kind of approach. Now, the way that works is essentially this person will, in a way, loan you money or prepay for some shares whose price will be set later by kind of a later round investor, because it's just way too early to decide what your company is worth today. This works in your benefit as well, not just from the time perspective, but also from the perspective of, look, you might be giving up too much of your company without knowing it. 6 months down the road or a year down the road, you may realize my company was theoretically worth much more than I originally attributed to it. So instead of going down that road, we often say to companies, look, if you know you're going to be raising money in the next 6 to 9 months, maybe the better way to do it is to take a convertible debt approach. Now, let's say you come to the next stage where you're actually doing a decent, maybe it's an A round, a Series A round, or a pre-Series A round, but a good size round, let's say $500,000 or something like that. That's the stage where you'll have, um, if not professional, you'll have at least semi-professional investors getting involved. And when I say semi-professional, what I mean by that is a very sophisticated angel, perhaps, or an angel group, right? Who are not doing this, necessarily for a living, but they've done it often enough that they know the norms. Now, each of those kinds of people typically has a certain ownership requirement, and that's a great way to figure out, okay, if so and so is willing to invest X dollars that I'm asking for and requires so and so percentage of ownership in my company, as a matter of course, then that pretty much decides the valuation of my company, right? So that should be quite clear. Another way that investors often think about it is, if I'm investing in this company today, and I sort of see this company being worth a certain number, let's for sake of an example, $100 million in 4 years, which is my time horizon. And at that 4-year time period, I will own, let's say, 15% of the company. Then I, in effect, have $15 million worth, held in that company. If my required return is going to be a certain, ROI in those 4 years, then this is the maximum valuation I should be paying today. So if that required return is 5 times, let's say, or 10 times, whatever the number may be in that investor's mind, then they will discount that back to today, right? So that's another way to do it. A third way is to look at, and this is harder to do because it's not enough transaction data, in the geographies that we're talking about, India and Southeast Asia. You can look at the companies which got funded at similar stages of business as your own, and figure out how much did investors pay for those. It's actually quite unlikely that you will find a company that is almost identical to yours in the same industry at the same stage with data available, right? So this is a little bit of a shot in the dark, and a very small sample size if you can get any data. But if you do get the data, it helps you triangulate. So there's 3 or 4 different ways you can arrive at certain numbers. If those numbers are 10x apart or even 5x apart, then obviously there's a problem. But generally speaking, at least in my experience, and I'm sure Wispy will back me up on this, we don't see that much variance across these. Wispy, what else do you think?
I'd say the last thing I would put on this topic is, something that supersedes almost everything we've discussed is figuring out where the bargaining power lies. And valuations are a negotiation between you and your investor. And if you have multiple parties interested to invest in your company, you're in a much better negotiating position than you were if you had only one. So I would say valuation, at the bottom line, at the end of the day, valuation is market determined, i.e. determined by the number of investors you have interested. And if you have multiple parties interested, you can negotiate with them, having the other in your hand for the right amount and the right value. This is not to say that valuation is the only parameter you should ever look at when choosing an investor, but it is one of the parameters, and having multiple parties interested is the ultimate bargaining weapon.
Totally agree. And I think we both have seen this also from the entrepreneur side when we have companies in our portfolio who go and raise money in future, right? So where we also are looking to optimize to the upside valuation of the company, right? I'd just add one last point to what you've just said, which is sometimes entrepreneurs make the mistake, particularly entrepreneurs who've got, let's say, 3 investors interested, of trying to over-optimize, right? Beyond the point, having somebody invest is in a way more important than whether you've got the absolute last decimal point increase in valuation, right? Having the right partner, having actually the cash in the bank, that's much more important than optimizing the last 5% or whatever the number may be. Chris Dixon and several others, in fact, have written posts about this, that if you've got 5 great guys who are interested in investing in your company and you get them to good enough valuation, don't be greedy. You've got to leave something on the table so that the deal actually happens, and so that you have a good relationship with your early stage investors. I've also done a couple of posts on this in the past, which I'll put down in the comments to this video. And so please go take a look.